Now, in today's Market Navigator segment, one of the biggest sectors impacted by the Fed's pending policy adjustment would be, of course, housing, interest rates. Any rate adjustment is still a key and still likely a ways off, but one options trader is using that time to her advantage. So joining us now is Jessica Inskip, Director of Investor Research at stockbrokers.com. And Jessica, you're looking at using options to play homebuilder DR Horton. So take us through what exactly the trade would be and why.
Yeah, absolutely. So as options traders, we can utilize options to buy and sell securities from the sell side of options because it creates an obligation to buy or sell. We collect an upfront premium. So today, the way I want to do that is I'm actually utilizing DHI, DR Horton. You know, just like you stated, there is a housing supply issue. Rate cuts are certainly on the horizon, but because there is this still pressure from an inflationary perspective for houses, it's a supply side issue, not a demand issue, almost like NVIDIA without the technology aspect, I suppose. But DR Horton, they had good earnings. They reported at the high end of guidance. They still are showing resilient margins that are expanding. They're up 24%, so representing a quarter over quarter increase of about 80 basis points. But what really I took away from their earnings is the statement of choppy traffic patterns. Now, from a technical perspective, I would take that back and say, okay, what are you seeing from those choppy traffic patterns? And I really think that alludes to the 10-year and the choppiness that we're seeing. And those consumers are being hesitant really to go into those houses. And they're going to elude that, of course, with elevating those incentives and buying down those mortgages like we've seen. From a technical perspective, I look at the 13, 26, and 40 moving averages. That represents 1, 2, and 3/4 worth of prices. I want to see that increase. That is absolutely happening. This is a beautiful chart with DR Horton. But I look for momentum. I'm looking at the Bollinger Bands. And when it hugs, that means it's on the higher end of the standard deviation. So when we're making higher highs, I want that to be aggressive and show that momentum, which is what I see. But I also want to consider the overall macro picture, which is we're getting to higher highs with the overall market, which could lead to consolidation, which means I need to mirror really my macro view with a micro view with an option strategy. And that's where the cash secured play comes into play.
All right, Jessica, just to kind of put a point on this, right? So the optimal outcome is that you basically collect this premium and the stock just keeps going higher and nothing happens except you collect the premium. Or at the very worst, you actually get put the stock by the time it's done.
Yeah, absolutely. And it's a wonderful way to utilize options to get a neutral to bullish view, especially if you have any type of trepidations on the market or just for consistent income purposes. The way that I'm structuring this one, though, I'm selling the October 4th, 2024, 187.5 puts. I'm collecting about 570. That was earlier today when DR was around 190. But what that does, that upfront premium is reducing my overall risk allocation. So I'm creating a cushion. If it were to move down, I've moved my break even to about 180, 180. So it's really the way that I personally do as an options trader and very commonly utilized, where we sell puts to buy the stock, utilizing that obligation. And you can do the same thing, of course, on the sell side if I was put, which I would absolutely intend to do to still participate in capital appreciation while creating consistent income. That is the entire intent of this strategy.
All right, Jessica Inskip, stockbrokers.com. Thank you very much. We'll see you again soon.